saving, investment, and the financial system. This chapter is an excellent follow-up to the previous one discussing production and growth. In that chapter, we learned that investment, which is the accumulation of capital, is important because it leads to a higher standard of living in the long run. But what determines how much investment, but you have to take a look at what determines how much investment a country undertakes. That's the essential central question of this chapter. Again, what determines how much investment a country undertakes? So, after some introductory information about various types of financial institutions, this chapter focuses on saving and investment. You will learn the difference between private and public saving and the definitions of government budget surpluses and deficits. Now, there is a brief review of the difference between saving and investment that is very useful. And for you as intro-level students, there's often a term called investment. And what we're saying there is we mean saving. So when you hear investment, think saving. The most analytical part of this chapter is the coverage of the closed economy loanable funds model. However, this model uses the tools of supply and demand, which we introduced in Chapter 4, so you should be familiar with that. Now, the loanable funds model shows how the interest rate adjusts to equate saving and investment in a closed economy. You will also learn how government budget deficits can crowd out investment, and which is actually one of the bigger issues in macroeconomics. So let's get started. Now, financial institutions, what are they? Well, the financial system is a group of institutions that help match the saving of one person with the investment of another. So you have savers and you have people who need to borrow. You have savers and you have people who need to borrow, but you also have people that have investment opportunities. So that's a financial system. Now, financial markets are institutions through which savers can directly provide funds to borrowers. Examples of financial markets are the bond market. A bond is a certificate of indebtedness. And the stock market. A stock is a claim to partial ownership in a firm. Now, most people think of the stock market. You literally own a piece of a firm. And the bond market, which you may be less familiar with, is you're essentially giving small loans to the borrower. Now, financial intermediaries are needed. And financial intermediaries are institutions through which savers can indirectly provide provide funds to borrowers. Examples include banks, obviously they provide loans, and also mutual funds, which are institutions that sell shares to the public and use the proceeds to buy portfolios of stocks and bonds. So this chapter, a big part of your success in this chapter is going to be wrapping your mind around the reading and getting the terms down pat. So be sure you're doing that. So there's different kinds of saving. First, there's private saving, which is the portion of household's income that is not used for consumption or paying taxes. Now here, we have our income here, Y. T is not just for taxes, it's actually transfer payments. Now taxes are a form of transfer payments, and C is consumption. So your income minus what you pay the government, say in transfers, in the form of taxes, and then obviously minus what you spend. Whatever you have left over after all that is something that you can use for private saving. Now, public saving is tax revenue less government spending. So you take the tax revenue here, the transfer payments, T, and you take out what the government spends. Okay, so if the government's running a surplus, you're going to have some money for public saving. If a government is running a deficit, meaning they're spending more money than they're bringing in, you're not going to have some money for public saving. Pretty much anyone can guess what we're doing in America right now. So just in case you get curious, T here and in general is a net of transfer payments. In general, saving is just some measure of income minus some measure of expenditure. It's just whatever you have left over. For private household saving, the measure of income is disposable income or gross income minus taxes. In other words, your take-home pay. And the measure of expenditure is your consumption. For public government saving, the measure of income is T, which is total taxes, which is the government's source of income. So that's how government makes money through taxes. The measure of of expenditure is simply G, which is whatever the government purchases. Now, in case of national saving, which is covered on the next slide, the measure of income is GDP, which we've talked about before, and the measure of expenditure is consumption plus government expenditure, so C plus G. Now, national saving, again, is private saving plus public saving. So we had our private saving, your income minus what you pay in taxes minus what you consume is your private saving. And then public saving, your tax revenue coming into the government, and then what the government spends, whatever you have left over, can be used for public saving. So you add the two savings together, you have national saving. Now, you can simplify this equation by canceling out the T's, and here you just have your income minus your consumption minus what the government spends. So you have total income. In this form, it's going to be go back to Y being GDP minus what people spend minus what the government spends, and that's your national saving. Okay, so national saving again is the portion of national income that is not used for consumption or government purchases. So now recall that the national income accounting identity is GDP, and so Y equals consumption plus investment plus government spending plus net exports. Now, for the rest of this chapter, we're going to focus on the closed economy case. Okay, so we're not going to pay attention to imports and exports. We're going to drop net exports. So we're going to look at the income being consumption plus investment plus government spending. So here you can solve for I. You can solve for investment because that's what we're concerned with here. Literally, it's just rearranging the equation. Investment equals Y minus C minus G. So your income minus your consumption minus your government spending. So that translates back to our previous slide when we say national saving was Y minus T minus C, which is private saving, plus whatever we have public saving, which is T minus G. Again, we canceled the T's out, and we have Y minus C minus G. Okay. So saving is the investment in a closed economy. So for this particular portion of this chapter, or this rest of this chapter, we're going to look at a closed economy. So we're not considering net exports here. We're not looking at import and export. So in defense of using a closed economy assumption, while it's true that most economies are open, the closed economy case is easier to learn. All right, so it's easier to learn, so you should be all about it right there from the get-go. But we can still learn a lot about how the world works by studying a closed economy. We just make a lot of assumptions that they're not making trade. Okay. A later chapter that we'll go over, we're going to add international trade and capital flows to this model. But for now, I want you guys to learn it in a closed economy situation. Now, budget deficits and surpluses. Big deal. A budget surplus is when there's an excess of tax revenue over government spending. In other words, the tax revenue the government brings in is greater than your government spending. You have that in the form of public saving then. Budget deficit, much more likely given, our last 50 years mostly in the U.S., budget deficits are shortfall of tax revenue from government spending. Now, I shouldn't poo-poo all politicians. There have been some balanced budgets. Reagan did it at least once. Clinton did it maybe at least twice. So it's not really a donkeys and elephants issue. It's something that can be done. It's just unfortunately hasn't been done here lately. Balancing a budget, having a surplus, that is. Now, budget deficits, again, much more likely, as recent history has shown us, it's a shortfall of tax revenue from government spending. Now, you take government spending minus the tax, okay? Then you have a negative public saving because you have a deficit. You have more bills. You've bought more things than you have money for. Now, let's look at an example. Do some calculations. This exercise asks you to apply the concepts from the preceding slides that are kind of a problem that you might see, say, on the coming exam. Given the following, let's make some calculations in part A here. Suppose GDP equals $10 trillion. Consumption equals $6.5 trillion. The government spends $2 trillion and has a budget deficit of $300 billion. Big numbers, right? Let's find the public saving, taxes, private saving, national saving, and investment. All right, so if you want to pause this right now and just jot those things down so you can follow along in your notes, that's great. But we are about to move to the next slide. Now, all of these numbers are in trillions of dollars, okay? So let's get that done. Let's get that out there and off the start. They're all in trillions of dollars. We're just simplifying them so we don't have a bunch of zeros on this slide. Now we're given income of 10 trillion. We have consumption of 6.5. We have government spending of 2. And the G minus T, government minus the taxation, is that'd be 300 million. Okay, 0.3 trillion. Okay. Public saving, again, is T minus G. So we would just say T minus G is negative 0.3. That would be 300 million. So public saving is in a deficit of 300 million. Taxes is T equals G minus that public saving, which is 1.7 trillion then. So that tells us how many taxes we have. Again, if you want to rewind here, you have to do the math. It might help you on the test. Private saving then, from the previous slides, we know is Y minus T minus C, your income minus the taxes you have to pay, the transfer payments you have to pay, and consumption. So that equals 10, given above, minus 1.7, which we calculated in taxes, minus the 6.5, which is our consumption. So private savings, 1.8 trillion. National saving then, we take Y minus C minus G. Okay, from the previous slide, we know Y is 10, because that's given. We know C is 6.5, consumption. And that leaves us, actually should be minus 2, not equals 2. So this should be a minus sign. Let me go ahead and fix that. Minus, well, if I could find it, minus 2. Okay. So that leaves us $1.5 trillion in national saving. Investment on national scale is your national saving, 1.5 trillion. So that's part A. Part B. How tax cuts affect saving. Use the numbers from the preceding exercise that we calculated, but suppose now that the government cuts taxes by 200 billion. Hey, that's great. Awesome. Everybody's happy. In which of the following two scenarios, in each of the following two scenarios, determine what happens to public saving, private saving, national saving, and investment. See what I'm talking about? All those terms? You're going to have to take some time to read this chapter, perhaps even reread it, so you know what these things are when I rattle them off as a test question. First, consumers save full proceeds of the tax cut. Okay, that's the first scenario. Consumers save full proceeds of the tax cut. They just save it. They say, man, that's great. I'm going to save all this money. The second scenario, consumers save only a quarter of the tax cut, so 1/4 of the tax cut, and they spend the other 3/4. And it's like, all right, let's go to Sizzler, let's spend this money. All right. This exercise is designed to teach an important lesson and prevent a common mistake among many students. So when you are asked, say on the exam, for example, to determine the effects of a tax cut on national saving, investment, and interest rate, many students will mistakenly state that the tax change has no effects on because taxes are positively an expression of public saving, negatively an expression of private saving. So it's money coming in for the government, it's money going out for the private folks, and not at all in the expression of national saving, which is that Y minus C minus G. This exercise gets you to see the effects of the tax cut on national saving and investment depending on behavior of consumers. Now, immediately following this exercise, we're going to look at a discussion question designed to help you realize that the tax cut will most likely cause consumption to rise and national saving to fall. So you're going to have to follow along here. Again, if I'm taking all this time to explain these scenarios, it might mean something come test time, right? So now, let's get started. Let's look at the answers to Part B. Again, Part B, we're looking at two scenarios here where consumers save full proceeds of the tax cut in the first scenario. In the other scenario, they only save a quarter and spend the other 3/4. Now, in both scenarios, public saving does fall. It falls by 200 billion. Well, that's the money that the government gave back in terms of lowering taxes. Now, the budget deficit rises from 300 billion to 500 billion. That's that same 200 billion. Okay, we don't have that tax revenue coming in, so the deficit goes up. All right. So in the first scenario, if consumers save the full 200 billion, national saving is unchanged. So investment is unchanged. All right, remember that tie between national saving and investment? Now in the second scenario, if consumers save 50 billion and spend 150 billion, okay, they're saving 50 billion, the 1/4, and they're spending 3/4 of it, 150 billion. That'd be nice, right? then national saving and investment each fall by 150 billion. Okay, national saving and investment each fall by 150 billion. It's that 3/4 amount that's no longer being saved. Again. All right. Now let's look at C. Let's look at a discussion question here. Here's the two scenarios. All right. The first one was, again, consumers save the full proceeds of the tax cut. The second one is consumers save 1/4 of the tax cut and spend the other 3/4. The questions are, which of these two scenarios do you think is more realistic? And why is this an important question? Now, if you have trouble understanding the first question, you can rephrase it in terms of that in a different way that perhaps it might be easier for you to grasp. For example, you could rephrase the first part like, suppose the tax cut causes your annual take-home pay to rise from $40,000 to $42,000. So taxes are lower, you're getting $2,000 more a year. What would you do with that extra $2,000? Okay, would you save all of it, or would you spend at least part of it? Think about that. That tells you which one of these is much more likely. In this light, most of you would agree that the most realistic scenario involves consumers spending at least part of the proceeds of the tax cut. Maybe getting something they need, getting something they want, right? The answer to the first question determines whether a tax cut reduces investment. So this is important because a fall in investment would cause, in the long run, a fall in the standard of living, because we're not investing towards production and growth, which we've established in the last chapter would really increase the quality of life. Okay. Now, the bigger point in all of this is that while tax cuts seem appealing, nobody likes paying taxes after all, I mean, it's, yeah, get rid of the taxes. I'm a big proponent of that. But they are not without cost. Later in the chapter, we will see how a tax cut causes investment to fall in a closed economy. Now, this is going to lend itself to what you're going to find out. The reason why that happens is that interest rates raise. But think about that thing if you get a little bit of a tax refund, or you get some, let's say it's a tax refund due to a direct tax cut. You get some money back. You're saving all that. We know the answer to that. You're not necessarily saving all that. In fact, you're probably not saving most of it. So that second example where consumers save 1/4 and spend 3/4 is probably the much more likely scenario. Now, let's move on. Let's talk about the meaning of saving and investment. Private saving is the income remaining after households pay their taxes and pay for consumption. Okay. Examples of what households do with saving, with their savings, what do they do with it? All right, it's just one thing to say, yeah, I'm just going to stash in a bank. But no, what do you actually do with it? Well, you can buy corporate bonds or equities, okay, invest in the market. You can purchase a certificate of deposit at a bank. It's usually a real safe investment. Doesn't have a whole lot of return, but, it's good for a nice little cushion if you need it. You can buy shares of a mutual fund. Okay, you can invest it. Or you can let it accumulate in a saving or checking account. All right, maybe like an emergency fund, something like that. Now, investment is the purchase of new capital. Think about this when we were talking about last chapter, talking about buying new physical capital. Okay. Examples of investments like General Motors spends $250 million to build a new factory in Flint, Michigan. All right. You buy $5,000 worth of computer equipment for your business. All right. Your parents spend $300,000 to have a new house built. All those things are investment. They're purchase of new capital. Now remember, in economics, this isn't finance. In economics, investment is not the purchase of stocks and bonds. A lot of people hear investment, they think, hey, it's just stocks and bonds. It's not. In economics, we can have an investment in terms of new capital. We can certainly invest in stocks and bonds, mutual funds. But what we're looking at here is the purchase of new capital. Now, in principle, you should already know the meaning of investment, which was introduced in Measuring National Income chapter. However, many of you may continue to think of investment as a purchase of stocks, bonds, and other assets. That's just kind of what you've been told over the years. At this point in the chapter, though, a review of saving and investment is especially worthwhile because the next topic is the loanable funds model within the closed economy. In this model, saving is the supply of funds and investment is the demand. So again, saving is the supply, brings funds into the market, and people who want to make investments are the demanders. All right. There's a connection between the economics definition of investment and the commonplace uses of the term, like stocks, bonds, etc. What lay people think of as financial investment, which is the purchase of stocks, bonds, etc., is what finances investment of physical capital. Okay, so when you buy a stock, that company uses that money that you bought to buy things like physical capital. For example, General Motors may sell $300 million worth of bonds, indebtedness, to raise funds it needs to pay for a new factory in Flint, Michigan. So they are linked. In this case, people buying the bonds are doing an investment in the layperson's sense of the term, buying stocks and bonds, etc. And GM is using their funds to pay for the physical investment to buy the new factory. Okay, so they are linked. They are linked, but we're just kind of cutting through it and saying investment is the purchase of new capital in economic terms. All right, we're taking out the middleman here. Now, the market for loanable funds, a supply and demand model of a financial system. Okay. Again, we're going to set up the market for loanable funds. It's a supply and demand model of the financial system. It helps us understand how the financial system coordinates saving and investment. Again, saving would be the suppliers, investment would be the demanders. And how government policies and other factors affect saving, investment, and the interest rate. My apologies, lost my spot here. Here we go. Now, let's assume there's only one financial market. All savers deposit their saving in this market. All borrowers take their loans out of this one market. All right, we're going to simplify here for introductory terms to make things a little easier for you to understand the market for loanable funds. There's one interest rate, which is both the return to saving, it's what the savers earn, and the cost of borrowing. It's the price that people pay to get a loan. It's the price that people get to save and invest. We know those things will be slightly different in the real world. Now, but in defense of this assumption of just one financial market, we're using this model to study the aggregate financial system, the overall financial system. It's fine to assume there's only one type of asset as long as we don't need to know how households divide their financial wealth into various types of assets. So we're just assuming they're all in one big pot, okay? Perhaps this analogy will help. Suppose you want to know how a fall in consumer income affects the automobile market. All right, reasonable question. You could draw a supply and demand model for automobiles in which there would be a demand curve would shift leftward. They would shift in. There'd be the leftward shift of the demand curve, causing the price and quantity to fall. Got less money, can afford less cars, your demand goes down. Of course, this model ignores the fact that there are lots of different types of vehicles, but that isn't relevant to the issue at hand. So we've been simplifying from day one. As soon as we drew a supply and demand model, now we're just drawing a supply and demand model for the market of loanable funds. Okay. Now, the supply of loanable funds comes from saving. Households with extra income can loan it out and earn interest. They can put it in the bank, they can invest it in different things and earn interest, and earn a payback on it. All right. Now, public saving, if positive, if we have a surplus, adds to the national saving and the supply of loanable funds. If negative, it reduces the national saving and the supply of loanable funds. Okay. So if we're running the deficit, it cuts not only into what the government has, but it cuts into what the market has. Now, let's put it on the graph. Here's the slope of the supply curve. An increase in the interest rate makes saving more attractive. Again, you're getting a higher price to supply money to the loanable funds market. Okay, a higher price. If you're a supplier, you want to supply more. Okay, same thing here. It's just here's the price, the interest rate. Here's the amount of loanable funds, the quantity of funds available. At a lower interest rate, people want to supply this amount. At a higher interest rate, guess what? It goes up. They want to supply this amount. All right, nothing's changed here from our previous models. Just talking about money and interest rates and loans. Now, the demand for loanable funds comes from investment. Okay, firms borrow the funds they need to pay for new equipment, factories, etc. Households borrow the funds they need to purchase, for example, new houses, cars, things like that. Okay, so there's a demand. You have a demand for investment. As a firm owner, you have a demand for investment. Okay, you need investment in your building to buy new equipment. Okay? If you're a business. Now let's look at the slope of the demand curve. A fall in the interest rate reduces the cost of borrowing, which increases the quantity of loanable funds demanded. Okay, here's your price again, your interest rate. That's just the price you have to pay to borrow funds. When it's high, you want less funds. When it goes down, you want more funds. Just like when price decreases, quantity demanded increases. Same thing. We're just talking about interest rates as prices and loanable funds as quantity. Same demand schedule here. All right. Where these two crazy kids get together? Well, we know it's equilibrium. The interest rate adjusts to equate supply and demand. It finds equilibrium. In this example, it finds it at 5%, where supply crosses demand, demand crosses supply, and the loanable funds in this market, $60 billion. The equilibrium quantity of loanable funds equals the equilibrium investment and equilibrium saving. It's just the equilibrium here, so where supply and demand gets together. Now, due to space constraints, this slide uses this LF over here, which stands for loanable funds, and EQM, which is equilibrium. So don't let that confuse you. So the equilibrium quantity of loanable funds equals the equilibrium investment and the equilibrium of savings. It's just where these crazy kids get together. All right. If the interest rate were lower than the equilibrium level, the demand for funds would exceed supply, causing the interest rate to rise. Okay. If it was lower, okay, demand would be over here, supply would be right here. They're going to have that invisible hand, going to push things towards equilibrium. And the rise in the rate would make borrowing more costly, thus reduce the demand for funds, so it wouldn't be over here anymore. As we get to equilibrium, it moves right here, okay? And then suppliers are willing to supply more at equilibrium than they were, say, if it was down here, if the interest rate was down here. All right. So that would encourage households to save more because it's higher interest rate, which would increase the supply of funds. This process will occur until equilibrium is achieved. That invisible hand pushes things towards equilibrium. For all the same reasons why we covered in Chapter 4 and every chapter since then. If the interest rate were higher than equilibrium, if it were up here, there would be a surplus of funds because they're getting a high price to supply funds that you've saved. So supply would be over here, demand would be over here. It's a higher price to borrow, a higher price to save. Same reason why you'd have a surplus and you'd have a shortage if it was down here. All right. The interest rate would fall to restore equilibrium. Again, invisible hand is going to push us to equilibrium. In the real world, the adjustment of equilibrium in financial markets is extremely rapid, changing all the time. Can shoot up, can shoot down. Here of late, interest rates have been kind of bottomed out. Everybody's anticipating an increase. Okay, we'll see. They go up, they go down. Now, let's take a look at a couple policies. First one is saving incentives. All right. Tax incentives for saving increase the supply of loanable funds. For some reason, there's some sort of incentive offered to increase savings. This reduces the equilibrium interest rate and increases the equilibrium quantity of loanable funds. So there's more funds to be had on the market. We go from 60 billion to 70 billion here, even though interest rates did decrease. There's an implicit assumption in this analysis that overall tax revenues remain unchanged in spite of tax incentives. Taken literally, we would have to assume that other taxes are raised to exactly offset the loss in revenue from the saving incentives. Without this implicit assumption, total tax revenues would fall, causing saving to fall and shifting the supply curve leftward, which would mitigate the effect shown here. Basically, supply would stay the same in that situation. You may or that may or may not have made sense to you, but the important thing to remember here is, again, just like the reason why we have a supply of loanable funds, we have a demand for loanable funds, and we know that when price changes, that's going to affect supply and demand. When there's shifts in supply, that's going to affect interest rates and prices. These things can shift. They can shift just like they did when we were talking about products, and it'll shift just the same way. Supply and demand works the exact same way. You just need to know that price is equivalent to your interest rate, and your loanable funds is your quantity. Okay. Let's look at a second policy. Investment incentives. So there's an incentive to invest more. We want people buying more, build more factories, that type of thing. So an investment tax credit, so you get some credit back into your taxes. You make it less expensive for people to build things like new factories, create jobs, that type of stuff. Investment tax credit increases the demand for loanable funds, which raises the equilibrium interest rate and increases the equilibrium quantity for loanable funds. Now, as with policy 1, we are assuming the tax credit does not significantly reduce the overall amount of taxes. If total taxes fell, then supply curve would shift in addition to the demand curve. However, our intention here is to focus solely on the demand shift. So we're looking here just one shift, just like we're looking here with a supply shift, we're looking here with a demand shift. Just to know that those things shift. Again, interest rate is your equivalent of price of borrowing or saving, and loanable funds is the quantity. of the thing we're looking at here. Now, let's look at a scenario with budget deficits, because I don't know, it's pretty realistic. Use the loanable funds model to analyze the effects of a government budget deficit. We can draw a diagram showing the initial equilibrium. We can determine which curves shift when the government runs a budget deficit. We can draw a new curve on the diagram and find out what happens to the equilibrium values of interest rate and investment. Now that I've shown you the analysis policies 1 and 2, this exercise asks you to take a look at a third policy, which is a budget deficit. Now, a budget deficit reduces national saving in the supply of loanable funds, which increases the equilibrium interest rate and decreases the equilibrium quantity of loanable funds and investment. Okay, so long story short, supply shifts inward, interest rates go up, and loanable funds go down. Now, some may ask why the budget deficit shifts the supply curve rather than demand curve. After all, governments finance their deficit by borrowing. The reason is that we have defined supply of loanable funds as a flow of resources available to fund private investment. The budget deficit reduces this supply of resources. Now, in the real world, we sometimes see increases in government budget deficits that are not accompanied by dollar-for-dollar decreases in investment, as this analysis on the slide would predict. Keep in mind, however, that analysis here is for a closed economy model. All right, we're not considering an international model here. We're not considering international trade, net exports, that type of thing. In an open economy, firms can finance investment by borrowing from abroad. So they can borrow from other countries. They can borrow from abroad in the face of a decrease in domestic supply of loanable funds. So this decrease from here to here can be made up for by, say, borrowing from China or borrowing from another country. All right. This, of course, does not mean that the budget deficits are okay in an open economy. But the extra indebtedness requires service, such as an interest rate or dividend payments, which reduces the amount of income remaining for the residents of the country. In other words, if you borrow a lot to get from here to here, okay, you're going to owe somebody else something, and that money is going to be leaving the economy, which is not always a good thing. Or at least not really always a... I'm trying to think of a scenario where it's not a bad thing, right? Money leaving the economy is money that can be loaned out, spent, or used on investment to create production and growth. So you don't want to have a lot of indebtedness. Okay, somebody needs to tell Washington that. Now, budget deficits crowding out in the long run growth. In our analysis, there's been an increase in the budget deficit, which causes a fall in investment. Okay, when you don't have as much investment or you don't have as much money to invest, there's going to be a fall in investment, which is going to hurt your productivity and growth in the long run. The government borrows to finance this deficit, leaving less funds available for investment. So it kind of piggybacks. All right, this is called crowding out. Now, recall from the preceding chapter, investment is important for long-run economic growth. Hence, the budget deficit reduces the economy's growth rate and the future standard of living. Now, looking at the last point, while the budget deficit does not affect the steady state growth of growth theory, it affects the economy's growth rate temporarily, long enough to reduce the steady state level of income per capita. So people have less money, they have less money to save, you have less money to invest, and you have less money to grow in. And in some growth models, budget deficits can affect the steady state growth rate. All right, now I'm saying if you got less money coming in than you got going out, you got less money to invest. If you got less money to invest, you're going to get less return. And with less money to invest, an economy is going to struggle to grow and develop. Now, the U.S. government debt. All right, the government finances deficits by borrowing or selling government bonds. Their persistent deficits lead to a rising government debt. The ratio of government debt to GDP is a useful measure of the government's indebtedness relative to its ability to raise tax revenue. Historically, the debt to GDP ratio usually rises during wartime. Okay, so you have to take on more spending during wartime, and falls during peacetime. This was until the early 1980s. Let's take a look at it. You can see here, obviously, government debt went up greatly during wars, Revolutionary, Civil, World War I, and then boom, big spike in World War II. Okay, And then we look as recently as around 2010, we had a financial crisis. Now, note in recent years, the debt per GNP, our gross national product or income, is higher than any other time besides World War II. If you just look across here, I mean, there's a lot going on here in terms of real dollars. Big spike in World War II, and we're heading for a big spike as of in 2010. I can say that this number's somewhere probably around here. So from the beginning of this long time series that we're looking at until about 1980, the data shows a clear pattern. A debt to GDP ratio that jumps during wartime and comes back during peacetime. Also, the Great Depression caused revenues to plummet and led to a rise in debt ratio in the 1930s back here. See it creeping up before World War II. There are two reasons why economists believe it's appropriate to allow debt ratio to climb during wars. First, it allows the government to keep tax rates smooth over time, so there's not like these huge increases. Wars are expensive, and financing them with tax increases would be disruptive to the economy and would cause substantial reduction in economic efficiency. It's like, wow, here's your big bill. Now go out there and buy stuff. Yeah, right. Second, the debt finance shifts part of the cost of the war to future generations. Okay, other people are paying for whatever we're doing now. This is appropriate, one could argue, because future generations benefit from when the government goes to war to defend the nation against foreign aggressors. So the pattern is visible throughout most of history, which breaks down but it breaks down around 1980 when the debt ratio started climbing despite the lack of a major war. Okay, looking somewhere in here, that thing climb without a war. This was due to the Reagan tax cuts and the growth of federal entitlement outlays during the 1980s. Now, from 1992 to 2000, the longest expansion on record, plus a strong stock market from 1995 to about 2000, let's say, led to a surge in revenues. So we were kind of riding high. The first budget surpluses in many years and declining debt and GDP ratio. Now, from 2000 to 2005, the ratio started to climb again due to the Bush tax cuts and also the 2001 recession, and then the wars in Afghanistan, Iraq, and the war on terror in general. Now, the ratio shoots up dramatically from 2008 to 2010 due to the financial crisis and the recession. So that's why you start seeing it come up without a war here. Now, in conclusion, like many other markets, financial markets are governed by the forces of supply and demand. Right? One of the 10 principles in Chapter 1 was markets are usually a good way to organize economic activity. Financial markets help allocate the economy's scarce resources to their most efficient uses. Financial markets also link the present to the future. They enable savers to convert current income into future purchasing power. Think about what you invest. Eventually, you want to take that back out when you retire. That's your future purchasing power. And borrowers now can acquire the capital to produce goods and services that you can use in the future as well. So it's really pretty cool. It's linked up. This slide may oversimplify the issue, but it really is supply and demand. You just need to know the language around it to be able to navigate it. So in summary, the U.S. financial system is made up of many types of financial institutions like stock and bond markets, banks, and mutual funds. National saving equals private saving plus public saving. Okay, pretty simple. In a closed economy, national saving equals investment. The financial system makes this happen. Right? The supply of loanable funds comes from saving. The demand for funds comes from investment. The interest rate adjusts to balance the supply and demand of loanable funds to the market. Now, a government budget deficit is negative public saving. So it reduces national saving and the supply of funds available to finance investments. So if you're constantly running deficits, you can have less ability to finance investment within your own economy. So you have to borrow from other areas. When a budget deficit crowds out investment, it doesn't allow investment to happen. It reduces the growth and productivity. The growth of productivity and GDP. And we all know from the productivity chapter what a lower growth rate in GDP can have an effect on GDP per capita, incomes per capita, things like healthcare, how healthy people are, things like investment in schooling. And once those things start to go, the economy starts to really bottom out. It could potentially, In the U.S., we're talking about a slow stretch. We're not talking about people like in Mali where they're not able to eat or find clean water. However, if you don't have a means to have savers and investment folks to come together in a market format, to freely come together, it's really going to affect how much investment you can have, which affects how productive you can be, which is going to affect how much you can grow. So this wraps up a really jam-packed chapter. It's not overly long. It just has a lot of material in it that you guys are not going to be very familiar with. So the lecture is important, obviously. This video lecture, any live lecture, if you're a part of that, and then also the reading. The reading is going to be huge for this chapter. Okay, work through those examples. They're not overly difficult. The math's not overly difficult. But you have to know what you're doing to be able to do well on the exam and to, more importantly, grasp the concepts of saving, investment in the financial system. Feel free to let me know if you have any questions. Email, call, come by the office. I'd be happy to talk to you. Thank you.